Thank you for joining us for another My Wealth webinar. My name is Jeff Hunter. I'm an Associate Portfolio Manager with the Townsend, Samani and Hunter Group at Canaccord Genuity. Also on the line are Raheem Samani and Dave Townsend, Senior Investment Advisors with our group. Today we have Javed Mirza on the call. Javed is our Head Technical Analyst at Canaccord. He is an MBA and holds both the Chartered Financial Analyst and Chartered Market Technician designations. He's a very integral part of our decision-making process, and we're excited to have him on. He's always got something interesting to say, and he really takes a lot of the emotions out of the market and tells you exactly what he's seeing, as opposed to trying to interpret the emotions and make poor decisions on that. So it's a really good lens through a cloudy mirror. And with that, I'll pass it off to Javed. Javed, thanks again.
No problem. Thank you so much, everyone, for taking the time out of your busy schedules to join with us here today. So Jeff and team asked me to come on board and give you a chat, or I guess an update on our outlook here. So without further ado, I don't remember the last time we chatted, Jeff. Maybe that was some point last year, I want to say, like August or something.
Late fall, yeah.
Late fall, yeah.
Especially when everyone was
very bearish,
wanting to exit the market when you're pounding on the table to add some exposure. So yeah,
exactly. Yeah, so let's walk through. So I'll start with where we were, and then once you know where you've been, you can understand where you're going. So at the start of last year, we were very cautious on equity markets. Our target here was actually, I think, 20% below, believe it or not, what Wall Street was estimating. And the reason we were very cautious on equity markets is we saw a four-year cycle reset. And essentially, it's the contraction phase of the business cycle. Now, it takes place in one of two ways, either in terms of duration or magnitude. So duration is, call it 34 weeks, and you have a 10 to 12% correction. And then magnitude is where the damage is done in price, so a 15 to 20% correction. We had essentially a bit of both. We moved lower, just under 20% on the S&P 500. So, but the bottom line is we are extremely bullish here. As you guys recall from our last conversation, and starting in late October, we were telling clients, look, we think a new four-year cycle or cyclical bull market is taking hold. And that cyclical bull market has upside out into, call it, late 2025, early 2026. So we highlighted three reasons why that is. We'll talk about a variety of those reasons. But the bottom line is we're very bullish here on equity markets. Now, we call it the HFL cycle because we do believe that rates and inflation are going to be higher and in place for longer than most market participants anticipate. So there is a big change that has happened in markets, and we'll talk about some of those. And I think some of those, there's especially one very big change, which will likely bring back some memories for some people here on the call, and we'll talk about that as well. And that particularly has to do with yields. So our view right now remains unchanged. We believe we're in a secular bull market in equities that has upside by time into 2030. This bull right now is being driven by information technology and biotechnology. This is a 100-year chart of the S&P 500. So our view is out to 2030. We have the longest view of anyone on the street. And here you can see these blue arrows mark previous secular bull markets and equities, or essentially a period of rapid growth and innovation. And we believe in 2030, we're going to see the first, not the first, a secular bear market in equities take hold. Essentially a 10-year sideways trading range, and that's where you get this consolidation and adoption of new products and technologies. And for those of you on the call, you remember the 90s, especially the late 90s right here, you had this run up, people were talking about this new fad called the internet. And then we had this real speculative excess. But what we would say here is this period right here was where you really got that adoption of that new technology in terms of the internet. So we think we have upside out to 2030, and then I think things will get challenging. So we had this corrective phase take hold over the last 100 years. anytime you've entered into one of these secular bear markets, you've closed below the 4-year moving average on the S&P 500. And so I'll update everyone on the next slide. I'm going to zoom in a little bit here. And you can see here, this thin red line is the 4-year or 200-week moving average. This was in 2000. And then here, this was the financial crisis, and we closed below that key level. During the Euro crisis here, we touched and held above that level. This was the renminbi revaluation in 2016. This was US-China trade war 2018. The pandemic we actually view as a black swan event, similar to the 1987 stock market crash, so we don't really count that. And then here, we're calling what happened here, this is kind of the UK pension, the gilt crisis right here. And we once again came within spitting distance of that level. But the key takeaway is that we held above it. So right now, our view suggests that we remain in the secular bull market. This chart in front of you, 100 years. And these vertical lines illustrate these 4-year cycle lows. So every 3 to 5 years, you get these major lows, and that is not astrology, that is not, sign of the zodiac. What that is the business cycle. So our work suggests that every 3 to 5 years, the market goes through the business cycle. And we believe, and what we were telling clients last year, this was 2022, that was the peak. And then so through the bulk of 2022, we went through phases 4 and 5. And that's what we've been telling clients, look, that, we're ready to shift into phase 4. And in the middle of last year, we said, look, we think we're shifting into phase 5. So since late October, we were telling clients, look, we think we're starting a new market cycle. Now we think we're here somewhere. But the key takeaway is that we are now starting a new cyclical bull market. And things are fantastic from our perspective. Investor sentiment here on the institutional side remains extremely bearish. And the economic data, for the most part, continues to weaken. And as you can see here, this blue dotted line is economic data. But what you can see here, this is the market. And the market is a discounting mechanism, looks 6 to 9 months ahead. And this is what confounds most people, is the economic data is so bad, but the market is going up. And that's exactly what we're seeing here. And so these are the areas of the market that typically work in these phases. And so these are the more cyclical and risk-on areas of the market. Now, I know Jeff and the team out there, Raheem and David, they're going to want me to talk about energy. So energy, I'll talk about that in a bit more detail, but if you can just see this stylized, here was, from the 2020 pandemic low, I'm just going to draw a chart of energy. Here's energy, and then it kind of has moved sideways, but we definitely believe energy is at risk here. So we're cautious on energy. We're not saying we're going to see a repeat and, energy plummet here, but we do think it's going to be a relative underperformer. So assuming each of these phases, just to make things easy, is a year, this is 2023, this is 2024. So we don't expect energy to be back in the good books until the economy really is running in all cylinders here, and it's a late cycle play. So we believe this is going to be, call it 2025, 2026. So just a highlight out there on the energy space. And we'll talk about that in a bit more detail. I won't go into too much detail here. These are the sectors that are working in the US and in Canada: discretionary staples, materials, industrials. You can see energy has moved into quadrant 3. And just so you guys know, quadrant 2 is when momentum is in an uptrend and pushing higher. Quadrant 3, which is this quadrant right here, it wasn't an uptrend, but it's weakening. Quadrant 4 means it was in a downtrend and heading lower. And then quadrant 1 means it wasn't a downtrend, but it's bouncing. So definitely—
Can you just zoom in a little bit?
Pardon?
Can you just zoom in a little bit for—
Yeah, of course. Sorry, everyone. Yeah, so, and we really look at the US as kind of our barometer for global, the S&P 500 as a good barometer for markets in general. So you can see here, discretionary infotech and communication services have improved. And then the defensive sectors here, healthcare, utilities, staples, we believe that over the course of this year, they're ultimately going to move into quadrant 4 as the bull market really continues to assert itself. So our sector work is reinforcing what we're seeing here in the hypothetical market cycle model. So we're seeing technology, cyclicals, That's consumer discretionary, and then industrials and basic materials really work. So given the regional bank crisis, financials have been under pressure. But if we are correct here, then any weakness here is an opportunity to add exposure to financials. I think we might have, depending when we did the call with you, this is as of October 14th, 2022. So this was a day after the market low. But what we were telling clients is that this is percentage of stocks with bullish patterns. This is investor sentiment. And they're telling us the same thing. So these are blue shaded boxes highlight when these indicators have been bombed out. This is the pandemic. This is the US-China trade war. This is the renminbi revaluation. And then here, this is the UK gilt crisis. And you can see that once, everything is kind of going to hell in a handbasket, that's the best time to step in and add exposure. And so that's why that's what we're telling clients to do during that period in September and October. I won't talk too much about this. Typically, the third year of the presidential cycle is the most positive, and that's because the market understands what the president can or can't get through Congress. And just as a side note, the market doesn't hate bad news, it hates uncertainty. And the reason the third year is pretty strong on average, because you've removed that uncertainty around the representation in the House. For this map just charts out the average track of the 4-year cycle. That's this blue dotted line, and this is the October 13th low. So you can see we are starting to track and trend higher for the average track of a new 4-year cycle. Now, what I'm going to focus on here quickly is just to highlight why, or view basically financial instruments that are reinforcing our view that a new cyclical or 3 to 5 year bull market is underway. So on the left-hand side is the DAX, and I'll zoom in a little bit here so everyone can see much more clearly. But the bottom line is we're testing these quarterly highs. I think we might actually be close to breaking out here today. But what's interesting is in France, the CAC has already broken out above the highs that we saw, even that were in place back in 2000. This is extremely bullish. This is the sign that globally a new bull market is underway. On the left-hand side, this is a North American investment grade credit default swap index. That's a lot of words, and ultimately it just is measuring fear in credit markets. So these red circles highlight previous peaks, and they coincided with major market lows. And you can see here, same thing happened in September, October. And you can see this little tick up. That's the regional banking crisis, because this is a bucket of a variety of swaps. And that's telling us we've passed peak fear in credit markets. And credit markets are usually known as the smart guys in this business. And they're telling us we're beyond peak fear. And then just in terms of cryptocurrencies, this is just another asset class that I know a lot of people are interested in. But the key takeaway is we've seen crypto regain this key technical level that it did at prior major market lows. So that's another strong positive there. Now, at the start of the conversation, we discussed a major shift that's underway that some people might remember. And what we're talking about here is rates rising. So this is ultimately, we don't have unfortunately, our service provider doesn't have data going back to World War II, but essentially from World War II onwards, you saw rates rising. And that really peaked here in the late 70s when you had that fight against inflation. And here in Canada, I know rates were, call it 20 to 24% during this period. The reason I'm bringing this up is because for 40 years since this peak, we've been in this longer term downtrend. But what we're seeing here is that this is a sell of a generation in bonds. This was, when we basically essentially hit zero. And since then, our technical work is identifying that this is a major trend change. And we believe what's going on is that we're in a new secular uptrend in yields. And I'll kind of plot out how we think this is going to happen. We think for the next, call it 2 years, rates are essentially going to remain sideways. And then as the economy really starts to heat up again, call it 2025, 2026, the Federal Reserve is going to hike again. But we don't believe the Fed is actually going to cut rates here. And the reason that matters is because, that reinforces our view that we're in this new longer term higher rate cycle. And then eventually, once we come out to 2030, and we think this is ultimately going to see the demise of the secular bull market is we are going to see rates in, call it 6 to 8 years, around this 7, 8%, 9% bound. And so that's going to be an important adjustment in general. And we think that's going to be a strong headwind. But like I said, ultimately this cycle and then the next cycle, I think we have at least 2 more cycles before rates really get that high. But this is a very significant breakout here by US 10-year yields. In terms of commodities, let me talk about crude and copper. So we do like copper a lot here. Our technical work suggests that it's accelerating, but we are very cautious on crude. And so what we want to highlight, especially given that a lot of people here from central Canada here are on the call. So this was the last cycle where you have this uptrend and then you have this sideways consolidation, this breakdown, and then this sideways consolidation. And all of this movement coincides with the market cycle model that we highlighted earlier. So here's another example. This is phases 1 and 2, and then ultimately 3. Here's the consolidation phase, here's the markdown. But what we think is poised to happen for crude is we think it's going to be essentially trading in a range between, call it 85 and 60 for the next couple of years. So call it out to, we're midway through 2023, so maybe towards the start of 2025, and at that point it's going to start to tick up again. So at the very least, we think crude is going to be in a sideways trading range, very similar to yields, and as a result, energy stocks we believe are likely to underperform. Now, at the start of the year, we highlighted a variety of ideas, and we'll just quickly walk over those. So one of those was just aerospace and defense, given the conflict in Ukraine. The second one was that copper miners and steel miners would outperform, and these charts look very positive. You have to recall, at the end of December 2022, things were quite bearish. Sentiment was extremely bearish, and at that point, basically, people were very cautious on equity markets, but our work suggested that these areas of the market were poised to push higher, and they have and continue to push higher. In terms of our most contrary predictions for this year, one was home builders. I think in December of last year, housing starts in the US were pretty abysmal. And if you look at this chart, it's continuing to push higher and looks like it wants to make new all-time highs. So that's another one of these indicators that from if you just look at it in general, it doesn't make sense. But if you realize the market is always looking 6 to 9 months ahead, and it's looking at economic improvement and prosperity, then it does make sense. So we do like real estate this year, despite these higher yields, just because it has come under a lot of pressure. But we are very likely to shy away from it, next year. But anyways, we'll see how that looks when we get there. 2 more charts just highlighting that we're in a bull market globally. Argentina has already broken out to new highs, and then Mexico right now, as we speak, is breaking out to new highs. Very, very positive developments globally. I know a lot of people are obviously focused on North America, Canada, the US, but if you look globally at what's going on, and you're seeing this in Europe too, Greece has already broken out to new highs, France, there are a lot of positive developments. And then finally, last but not least, we highlighted gold and platinum as our ideas for this year. They do look like they want to push higher, especially if the Federal Reserve is going to go on pause. That's going to remove the Bitcoin. I'm just going to skip the next couple of pages, and I think I'll essentially leave it there and then turn it back over to Jeff and the team for any questions. I think one thing I will address is, I think Rahim was asking about AI and the potential impact we're seeing here. And I mean, you're seeing it in the charts, a variety of these US large mega cap tech that are associated with AI. So call it Microsoft, Google, NVIDIA, those charts are definitely improving. NVIDIA, as we speak, is up around 4+% today, and it looks like it wants to break out to new highs here on the horizon. And then just Apple is another chart that looks very constructive. And if you look at these charts and you look at the noise, the news, that's a Freudian slip, if there ever was one. they're telling you two different stories, right? And I think that's where you really can rely on Jeff and Raheem and David and the team to separate the noise from what's actually going on. And this is, I apologize for my language as I'm about to say this, but the news is kind of bullshit, and this is money. This is what real money is doing. It's reflected in the price. It doesn't get changed. This is what actually happens. And so, like I said, we're very bullish here, and this kind of reinforces that view, or that very important saying is that money talks, bullshit walks, and right now the money is really telling us that things are improving and that we want to move higher from here. So I'll turn it back over to the team for any questions.
Hey, Javed, just another question here, and thanks for addressing AI. I think it's going to be pretty phenomenal, the effect on productivity and efficiency in the coming years, and I think many are amiss on artificial intelligence and machine learning as the next sort of wave. But the election cycle shaping up now in the US towards the back half of this year and all throughout next year. Thoughts on that as a sort of positive influence on the markets and general election cycles, if you could comment on that.
Yeah, great question, Raheem. So I think what I'll do is I'll kind of zoom in on this. This is just a chart here of the S&P 500 from back in March. But I think if you step back and really look at what's going on here, we've had this big correction. We were calling for it at the start of 2022, and the market has repaired itself and it's heading higher. So what you're going to see over the course, especially in the next year, and although it doesn't feel that way, you can see these kind of red areas here, and we're going to get some news, some noise as we head out into that time frame. So we ultimately believe those are going to be opportunities and to add equity exposure, because if we're correct, this next cycle, which is starting right here, right now, is likely going to take us out into, call it, late 2025, early 2026. So we're going to have some noise here over the next couple of years, but we view that as an opportunity. And we'd only really start getting cautious in late 2025, early 2026, because I think at that point, we're going to really start to get closer to the market top. So for right now, ignore what's going on in the news, kind of focus on what the market is telling us. And right now, the market is telling us we're in a new cyclical bull market that we should have upside out into, call it 2025, late 2026. I hope that helps kind of place your question into the context of how we view markets and where we see things heading, Raheem.
Perfect. If there's anyone with any questions, there is a Q&A button in the bottom. Just type something in and we can ask it on your behalf. Any other how are you viewing on airlines? We're starting to see I noticed your comment on Air Canada. Some of the US ones are still fairly weak in price in price and return. Can you kind of comment on that?
100%. So we think it's an attractive entry point here. We highlighted Air Canada for the team as our chart of the day today. It's testing a key technical level, but we're seeing the same setup across the board in airlines in the US, and they actually flag really well in terms of our quantitative model. We have a quantitative model we look at as well, and they're flagging really high in terms of value. So that aligns really nicely with our work, because we think we're here somewhere. And if we are seeing that the next 2 years are going to be positive, then those more cyclical areas are definitely poised to benefit from this. And I'm sure you guys have discussed this as well. And us personally, we went on our first vacation in 3+ years in February of this year. So I know there's a lot of people who are probably in that same boat. And so we definitely see that there's these pressures to get out and let life be normal again after a couple of challenging years.
Thoughts on natural gas?
Well, it's funny. So we actually have natural gas here. We recommended this back let me just go to this. So we recommended this back in February. We have this seasonality ranker that we put out every 3 months. So let me just zoom in here just so people can see, and I'll talk about natural gas. So this was back in February that we put this out. We were just recommending, and the reason we were highlighting natural gas is because if you take a look here on average, and I'm sure there's people on this call who know this market much better than we do, but from March to May on average, natural gas has a pretty strong seasonality. Those are the average returns for each month. And right here, this is the percentage of times that natural gas closes the month higher than it started. So you can see there's kind of this sweet spot into the end of May. We've got another 2 weeks and natural gas has started to improve. So I think it's right now it's still oscillating around this level. So just to let you guys know, we recommended this somewhere here in February. So I think we're marginally down or kind of flat on this call, but I know it's rallying here today. But what I'd like to highlight is, you've got some upside. You know what, I'll pull up my most recent weekly note. This is from a couple of weeks ago. So let me just pull up my most recent weekly note and I can talk about it in more detail. Just give me 1 second. Oh, there it is. Let me just highlight this. Okay, so yeah, so you can see natural gas is trying to find a floor here, and what we're seeing is it trying to stabilize. So we recommended this back here, call it around the 240 level. It's trading. I know it's having a good day today. I think we might end up being flat, but the bottom line is you had this big downtrend. I'll show you over here, and big downtrend, counter trend bounce, big downtrend, and now what you're trying to do here is kind of form this sideways base. So I don't mind nibbling here as long as you have tight stops. I'd be limiting risk here near this 2 level, but the bottom line is it does look like it's improving and setting up for a bounce, at least towards this 322 level. Anyways, hopefully that helps.
Where do you see volatility going from here? So
this is one of the things that really reinforces the review of why we're bullish. This is what I'm showing everyone is just the weekly note that comes out. If anyone's interested in seeing this, I'm sure you can reach out to Jeff, Raheem, and David, and they can flip this to you. But what I'm showing you right now is this is the VIX. This is over the last 3 years. This is the volatility index. It just tells you in a nutshell how much uncertainty is currently in the market. And the key takeaway is this is where the market bottomed right here in October. And notice since then, volatility has really begun to ebb. So, and you can see here, this is on a weekly chart, a long-term time frame. And then after the pandemic, you saw the highs up here, but all the way into 2022, basically, that's where, and this was in line with the market rally. And then when the market started to come under pressure, you can really see volatility picking up. So the key point or takeaway here is that this move lower in volatility reinforces our very bullish view. Now, you can have these short-term spikes here. This was the regional bank crisis. And, down in the road, you are going to have spikes like this. I'm sure once we go through the election cycle, even in this big uptrend, you still had these spikes now and again. But like I said, that really review out into, call it 2025, as opportunities to add exposure on any sort of, news event that puts fear in the markets.
Raheem, any other comments or questions?
We get a lot of comments from investors who are invested in real estate REITs specifically. Are you seeing stabilization in that sector right now? I know obviously it's very sensitive to rising rates and naturally yields, competing yields right now, risks free versus growth versus income. So, just thoughts about, REITs and in terms of when investors should start to see somewhat of a moderation or a turnaround there.
Yeah, great question. So, I mean, we highlighted this is one of our ideas for this year because we think they got overly punished last year. But given our view on yields, I mean, especially here in Canada, like I live near Toronto, and real estate, of course, is you know, kind of loopy, the prices. But what we do expect, given that rates are going to be higher, is this kind of flattening and trend over the course of the, call it the next 5 to 10 years. So we do think, and you bring up some great points, and I think this chart is very important, is if we do expect rates to rise longer term, then that is going to ultimately be a headwind. But I think this will set up an opportunity, call it, you know, 5 to 10 years from now, when rates peak again. And I don't know how high they're going to get. Maybe they get, you know, 8%, 10%, but that will create another opportunity at that point to you know, really add exposure. But we do think, if we're correct here, I think the next 2 years real estate returns will be decent. But as we get into the end of the cycle, when the Fed, we believe, is forced to hike again, that is really going to create some tailwinds, some headwinds for the real estate space. So hopefully that helps answer your question.
Great.
Awesome. Well, Javed, thank you very much for your time. Always appreciate your thoughts and insight. For everyone else, we'll be sending out the replay as soon as it's approved. And if you have any questions, feel free to reach out to me, Raheem, or Dave. More than happy to get an answer and talk further. Have a great afternoon. Bye for now.
Perfect. Thanks for taking the time, everyone.